Hello, property navigators. Today we are exploring the key differences between metro and regional property investment markets. This isn't about making one option look better than the other, but rather giving you the information you need to make the right decision for your own strategy. Let's get going. Let's begin by talking about metro areas, usually referring to a major city and its surrounding suburbs. These areas are characterized by high population density, extensive infrastructure, and a concentration of services, industries, and other amenities, including entertainment and lifestyle. Cities like Sydney, Melbourne, Brisbane, Adelaide, and Perth. These are the bustling, highly populated areas that most of us are familiar with. Why are we familiar with them? Because according to the Australian Institute of Health and Welfare, 73% of our total population is concentrated in Australia's major cities. This is one of the biggest reasons a ton of people want to invest in metro areas. It's familiarity. People generally like locations they know. It's comforting, you know what's going on, you can easily visit the property, understand the local market, and feel more in control. At the very least, most Aussies know of these cities well enough to get that sense of familiarity, to know it is a safe option rather than a location that's never been heard of. Metropolitan areas typically have higher demand for housing, naturally because of the population density we just spoke about, and also because of population growth. This is natural growth from the millions of people that live in the area, but also and more predominantly from migration. ABS shows that in 2022 and 23, Australia had a net gain of 518,000 overseas migrants, with the majority moving to a capital city area. FYI, we have a whole video on this and the link is just down in the description. With this kind of population density and growth comes some very important factors you need to understand. Rental demand, infrastructure and development, employment, and access to amenities. Number one, rental demand. Nearly 1/3 of Aussies rent their shelter as per the Australian Bureau of Statistics. Rental demand is not only stronger but very reliant in metropolitan areas as they are population hubs, so more people in the overall population are renting. Number two, infrastructure and development. Ongoing infrastructure projects are required to keep these population hubs developing to meet the needs of the growing population. So billions of dollars worth of projects are pumped into these areas, and as we know, the right infrastructure projects can enhance property values over time quite significantly. We have an entire video on this topic too, and the link is just down in the description. Number three, employment opportunities. Metro cities have more employment opportunities due to their larger populations and concentration of industries including finance, technology, and healthcare, to name a few. These cities are usually home to the headquarters of major corporations which attract businesses and talent. Additionally, the presence of major educational institutions, cultural attractions, and government offices further expand job prospects. And four, amenities. Metro areas offer a wide and diverse range of amenities, including extensive entertainment options such as theatres, concert halls, and touring artists, along with vibrant nightlifes. They feature diverse dining experiences, large shopping centres, and world-class hospitals, health and wellness facilities. Access to prestigious educational institutions, well-developed public transportation, and a rich cultural scene with numerous art galleries, museums, and festivals are also usually on offer. Economic diversity is another strength of metro areas. This means the economy is not reliant on a single industry or just a few industries. Instead, there's a large mix of sectors. This diversification helps to reduce the volatility of the property market, making it a stable investment option. In metro areas, there's also typically a lack of new supply, especially in established neighbourhoods. Most of these areas are already built out, which means there's little room for new development. This scarcity can drive up property values over time as demand continues to outstrip supply. This is important to fully understand, and we have a whole video dedicated to supply and demand, and the link is also just down in the description. All these factors generally lead to what could be considered stable and secure growth. Millions of people not only rely on these markets but support their existence. This often leads the potential for steady capital growth over the long term purely from a demand perspective. However, investing in metro areas isn't without its downsides. Big one here is affordability. Metro properties, especially in quality locations, can be quite expensive. This high entry cost might require substantial upfront capital, which could be a barrier for some investors and likely most everyday Aussies. This can lead to lower rental yields because prices are quite high. Rental yields tend to decline because of the higher cost of property. Depending on when you buy, yields could compress for some time and may not come up to a point where you need them to be in terms of your cash flow. Another challenge in metro areas is the potential for high volatility, especially in more expensive suburbs. While these areas can offer the highest yields, they can also experience significant lows during market downturns. The higher, more expensive end of markets tend to ride the peaks and troughs the hardest. Developers are most active in metro areas as well, which could be a double-edged sword. While development can indicate growth, it also means more competition. High-density developments like apartment complexes can suppress rental prices and slow down property appreciation, which leads us to, lastly, one of the most common pitfalls in metro areas is the temptation to invest in high-density assets like apartments, units, and townhouses. Even though in some cases they may show a higher rental yield on paper, remember, land appreciates while buildings depreciate. If you're investing in a metro area, make sure you're focusing on land-rich properties to maximize your investment returns. You can lose hundreds of thousands of dollars over a decade or two by focusing on yield over capital growth. We have a whole detailed video on this, and the link is just down in the description. Let's shift our focus. A regional area refers to towns, cities, and rural areas outside of the major metropolitan areas. These areas generally have lower population densities and may rely on one or just a few specific industries like agriculture, mining, or tourism. For example, we have towns like Toowoomba, Ballarat, and Geelong, which are still within the commuting distance to major cities, to more isolated centres like Townsville, where the local economy is self-sustaining. One of the biggest advantages of regional investing is the lower entry costs. Property prices in regional areas are generally lower than in metropolitan areas, making it easier for investors to enter the market with less capital. Quality properties in regional areas are often more affordable, ranging to $550,000. Because of the lower pricing, usually buyers get what is called a higher land to asset value ratio. A high land to asset value ratio indicates the land component of the purchase makes up the higher portion of the value rather than the buildings or structures on it. This means you're often getting the land for a great price. Because land appreciates in value over time, this can be advantageous by providing stronger investment potential, making them more likely to increase in value in the long term. Regional areas can typically offer high yields since property prices are lower, and when bought in the right areas, rental demand does remain strong. So investors can achieve solid rental returns, which can help cover outgoings and improve cash flow. Larger spikes in property values can also be experienced in regional areas. This is often due to significant government or private sector investments in infrastructure projects or industry, and it could even be due to tourism booms, all of which can draw in new residents and investors alike. Now, these spikes can be highly profitable if you catch them early, making regional areas attractive for those looking for rapid growth. But, and a massive but, is you have to catch them early to get in, and out for that matter, at the right times. This kind of growth can be volatile and unpredictable. Another benefit is lower vacancy rates. Regional towns often have stable demand without the constant influx of new developments that you see in metro areas. Often, once you find a quality tenant, and noting you're a quality landlord, which is really important too, they're likely to stay for longer periods, reducing the risk of extended vacancies. However, and a big one here to counter what I just said, tenant stability, i.e. tenant turnover, might be higher in regional areas, especially in locations with seasonal industries or where the population is less stable. So again, it's all about the right regional location you choose. Stronger negotiation power is another pro in regional areas because there is generally less demand, and that means there's usually more stock on market, meaning properties may stay in the market longer. Sellers may be more willing to negotiate on price, giving you the opportunity to secure a property below market value. However, regional investments come with their own set of challenges. Accessibility can be a significant issue. If you're a hands-on investor who likes to visit their properties regularly, the distance and travel time might be a bit of a drawback. And if you don't know of the town or area, you might have an emotional disposition to being able to understand that it is a good choice on paper. Some regional towns also have a lack of employment diversity. Such regions might rely heavily on only one or two industries, which means there is economic dependency. This makes the local economy more vulnerable to downturns in those sectors. This is something you want to be cautious about, as it can affect the long-term viability of your investment. If mining is the only industry keeping a town alive and half the mines shut, well, this can be a massive problem, as seen on screen in the case of Mackay in North Queensland. Population growth can also be slower in regional areas. While this isn't always a deal breaker, it does mean that property value appreciation might be more gradual, especially in towns that aren't experiencing significant economic growth. Additionally, when it comes time to sell, you might face longer days on market. Properties in regional areas often take longer to sell, which could be a challenge if you're looking to liquidate quickly. Gentrification is often slow in the regions too, so it's very important when buying into regional locations to choose the right street and suburb, because the difference between a good and bad location can be stark. Local knowledge is crucial here, as investing in the wrong area can significantly impact your property's performance. And there it is, the ins and outs of metro and regional investing. And remember, it's not about choosing one or the other. Investors choose to diversify their portfolios for what their strategy and portfolios require, and balancing the pros and cons of both metro and regional. If you still want some clarification, give us a buzz anytime. Until next time, happy property navigating.